Hey, welcome to the Acquirable Podcast. We're at the ACG event, and we are talking about all things selling businesses. And introduce yourself for here in a minute, but I want to talk about due diligence because that's your sweet spot. So introduce yourself to the folks here, and let's talk a little bit about due diligence.
Sure. It's Andy Tomat, and I've been doing M&A for more than 30 years. And a few years ago, I started a firm called 4 Pillars Due Diligence, which is supposed to focus specifically on due diligence on both the buy and the sell side.
Okay.
For companies anywhere from $25 to $250 million.
So Andy, due diligence is one of the most for an entrepreneur and leader, one of the most obtuse and scary phrases on the planet. Because and trust me, as a multi-time founder, every time due diligence came, it was always like, oh boy. What's going to get uncovered? What's going to be fine? But just let's talk about due diligence for the next several minutes. Define what it is, describe the experience, and I'm okay with you describing it with the way you just did before we started running, because it really is what it is. So let's define due diligence and describe due diligence.
Okay, so it's really, the crude term is it's a colonoscopy for a business, right?
It really is.
A lot of entrepreneurs feel that way.
Yep.
But it's like, don't you trust me? I've been running this business my entire life. Why are you asking all these questions?
Yeah.
And it's tough to explain to them on the sell side to be prepared for it. It's why do I have to do all this? And a lot of these first-time entrepreneurs, they may not have had any debt. They've been running it all on their own cash, so they've never had to go through getting their financials in order, going through all the stuff, due diligence they would have to go through with the bank.
Yep.
But the buyers, let's say private equity buyer.
Sure.
It's both the fund's got to justify to the LPs, and the fund's got to justify it to the lender.
Yep.
And so it's not that I often say, when I come in, I say, look, I'm here because I like what you've done with the business.
Yeah.
I've got to make sure all the boxes are checked to make sure we can finance and get this deal done.
So there's two things I want to double tap on. One is I think a lot of times entrepreneurs feel like you just said, why are you defensive? Why are you doing this? Don't you trust me? And this is not personal. Due diligence is not personal.
Absolutely.
And I think that's
but they all feel it is.
Exactly.
Because it's their business.
Yep. And I think that's that tension point that's like, if you can get to a place where you recognize this is not them against you, you versus them, personal, this is functional. This is a functional thing we have to do. So walk me through due diligence. If somebody watching this is going, I know I've heard the phrase due diligence, but what is a business financial colonoscopy as it relates to my business? Just to walk me through due diligence and kind of what it's defined as and what it means. Let's just break it down in its most simple way.
Okay, so I usually I talk about 4 pillars. That's the name of my business. So I talk about there's legal due diligence. Mm-hmm. That's one pillar.
Yep.
Are your certificates of incorporation done correctly? All the stuff that legally we can execute this transaction.
Right.
Then there's financial. That's probably the biggest.
Yeah.
And that's where you get all the accountants in the room.
Yeah.
And start going through the books. And many times the books are not done on a GAAP basis. People don't understand what's GAAP. They don't even know, right?
Yeah.
And then when we start to explain it and the numbers look different, they're like, well, that's not how I run my business on cash flow.
Yeah.
Cash in, cash out.
So
revenue,
let's pause
expense.
just for fun because we'll make this educational. Describe GAAP. Let's assume that these are the folks watching this that are like, I'm watching this to learn. So walk me through it. GAAP, explain that.
So I'll give you an example. So GAAP accounting is set when you bring in a CPA, certified public accountant from an outside firm. They have to follow generally accepted accounting principles.
Yep.
And there's a set of standards that are set in the U.S. by the AICPA.
Yep.
And I do European deals, so there's another whole set.
Yeah.
But it's how you present your books.
Yep.
And things like matching your expenses to your revenue. So let's say on a project.
Yep.
You may not get paid until the end, but you're incurring expenses all along. So you'll accrue revenue during that period so you can actually show what a profit and loss looks like.
Yep.
The converse, you may get paid ahead of time. You recognize the revenue, then you get the expenses. So we're trying to normalize that, especially across the years.
Yep.
That's the key part of GAAP.
Yep.
There's a whole bunch of other stuff related to, how accruals are done, depreciation, et cetera, and how an audit is done.
Yep.
So all that, but at its core is just trying to match expenses and revenues.
And what happens often to an entrepreneur or a business when all of a sudden they get hit with a different accounting method? Does this usually mean for them it's going to look less profitable, more profitable? Is it kind of, it depends?
Typically less.
Right.
And they don't understand why. They're
Yep.
like, but I made money on this job.
Yep.
Well, and sometimes it can show you really didn't when we look at the job by itself. But I got cash flow, et cetera. Well, maybe not. You think that now, but if we look past a couple of years, that's the other thing. We often have to look back 3 years.
Yep.
And trying to unravel that and figure out what really happened. That's a big challenge.
And that's why I wanted to double tap on this, because if you're looking to sell your business, getting ahead of this so that you can get an accurate view of what you're actually selling, because you might think you're selling one thing, but when you actually do the proper financial accounting on your business, it's going to look very different, and you need to know that.
Yeah, and I'll get another perfect example. Family-owned firm. Everybody runs family finances through the firm.
Right.
So we said, look, we got to pull that out. Mm-hmm. So then we get in. First, we have to say, what is EBITDA? Right? We have to start with this, which is actually not part of GAAP, but it's what we use in deals, right? So there's first, what is the traditional earnings before interest, taxes, and amortization?
Yep.
Then there's adjusted EBITDA, right? Which is what we do as bankers, right? But that all that adjustment is to try to say what is the business going to look like to a buyer?
Yep, exactly.
And usually that's pulling out everything from the leases, the family, what you pay yourself.
Yep.
The owner stuff, what you're paying for the family. I even have one deal where we had, what's this expense? Oh, that's for the airplane. What airplane? So
Right,
it's
yes.
pulling all that out to what does it look like to the buyer?
Right.
So that's the kind of work you have to do. Mm-hmm. But the way I try to sell it to, and that's usually a plus.
Right, exactly.
And that's how I sell it to a buyer is, look, going to GAAP is probably going to lower your earnings, your real earnings, and it's going to show you what it really looks like on a year-by-year basis. But adjusting the EBITDA is where we add back in the expenses that you incurred as a personally that the buyer is not going to do. So your number's going to look better. And then we key them in on saying, you need to understand how critical multiples are because that's how you're going to be priced. And so once they get that, start to get that, and they say, hey, then they come around and say, hey, I found another 100K.
Exactly.
And they know, okay, if I'm buying it for 10X, they've just gained $1 million.
Well, and they go from trying to hide all their slush fund decision making to go, hey, here's another thing that I've been the ball tickets, the house and wherever. You can really start to clean your business up because ultimately, like you said, the buyer isn't buying your jet. They're not buying your second house. They're not buying those things. And so it really gets clear. What would you say is the biggest mistake a entrepreneur makes leading up to this?
They try to make their business look better than it needs. They may defer expenses, or they may defer capital expenses. Or they may just make decisions and buy things that the buyer doesn't need. They're just not thinking they're thinking in their own thoughts, and they're not really understanding how they appeal. How is this decision going to be that I'm making, some major commitment, going to be made to a buyer?
That's a great point because oftentimes you might say, I want to sell in the next 2 years, let's say, and you go out and you go sign a 5-year lease on something that the future buyer was like, I have no interest in that. And now I'm stuck with it, and it's actually hurts your profitability of the business. So it is having that next view of what is my buyer interested in, and should I be engaging financially in things that they might not be? I mean, that's a great point.
Yeah, or for example, it's they've run the business, they're going to be retiring. Oh, they're going to need a CEO to run this. So I'm going to hire somebody today, and they get them an employment contract. They pay a lot of money, and it's like, some buyers may want that.
Right.
Many buyers may want to have a say in that.
Yep.
And third buyers may want to put their own person in.
Exactly.
So don't go ahead and make any commitments like that.
Wow. Yeah.
Without, discussing with your investment banker, discussing
Absolutely.
with your transaction attorney, and discussing with your accountant.
Absolutely. Absolutely.
Yeah.
What do you think is the best thing somebody could be doing in advance? Is it getting specific with their partners, like their bankers or attorneys? Let's say I'm 2 years out and I'm serious about a sell. What do I need to be doing today from your point
So
of
many
view?
of them come and they talk to an advisor and they say, "Hey, I just got an offer."
Yep.
Right?
Yeah, sure.
The worst time. to say,
Yeah.
Right? It's like, no, you should have talked to us and we haven't talked about taxes yet.
Yeah.
All of that work should happen 5 years before, because there are things you can do on the tax side that have a 5-year waiting period. So you really should start to think about it. When do you want to think retire? Who might buy your company? And you have to think broadly about that.
Yeah.
Typically, it's going to be this or that or this, but it may be a larger subset. So starting to engage with investment bankers, and they can be introduced through your from your attorney, from your CPA firm.
Yep.
I had a client, they talked to an investment banker years before they even talked to me,
Wow.
because they just needed to know what was coming up.
Let's talk about this 5-year situation. That's going to pique up ears and interest of folks. To double tap on that a little bit.
So I'll give you a perfect example. Lots of companies, their incorporation wasn't very well done.
Yeah.
They may have owned the company, and they owned, sort of an extreme example, they have the building and the company all in a C Corp.
Uh-huh.
C Corp is a terrible way to sell a company.
Right,
because you
right.
get taxed twice.
Yep.
There's a 5-year holding period by which you convert a C Corp into an S Corp and an LLC.
Yep.
And you can take the building over here. You can get it ready for sale.
Exactly.
Right? But then you can also do your own financial planning. How much do you want to take out of the business before you go?
Right.
Setting up your own retirement planning. It's never too early to start planning that and to get, wise about making decisions over the next 5 years. The other thing is, think about growing your business. You may have kind of been
Yeah.
happy.
Yep. Yeah.
Do I make an acquisition before?
Right.
How am I going to make sure that EBITDA number at the bottom
Exactly.
is as good as possible in 5 years?
Yeah. What happens if I'm in a C Corp and I'm like, I just got to be done. It's a great company, but I'm burned out. I'm done. And am I stuck now? Is there any way around the hold period?
Well, C Corps aren't as bad as they used to be.
Uh-huh.
The tax rates went
Yep.
down. So, getting a good tax strategist
Yeah.
can help. I mean, it's the whole C versus F versus LLC. It's all tax basis.
Right. Exactly.
So there are things you can do in that to help the transaction go well.
Yep.
So it's not as horrible as it used to be.
Right,
Because
right.
It used to be at all this, you get 20% plus 50%.
Right, right, right.
Crazy. So having that plan, understanding. The other thing is understanding what your cash flow looks like at an exit.
Yep.
Is very important, because it's people think, I'm going to sell my company for $50 million. How much cash are you going to walk away from, and what could you do before then,
Right.
to move some of that cash into your own personal retirement?
Right, exactly. Oh, that's a good, yeah.
Yeah.
That's a great point. That's a great point. All right, I'm an entrepreneur. I'm thinking about selling. Give me your pitch on, number one, why should I work with you, and what's the biggest piece of advice you're going to give me?
Okay, I'll use a real estate analogy.
Okay.
You got a great house in LA.
Yep.
It looks great. When you talk to a realtor, they're going to talk about staging your house. So it presents really well
Yep.
and very neutrally to whoever might buy it.
Yep.
Doesn't have all your stuff.
Right.
But it looks very nice.
Yeah.
So we're like the stager for a business.
Okay.
We help everything look really good in terms of your finances. Like we talked about legal and finances, but it's also your business.
Yeah.
Your marketing team, your marketing plan.
Yep.
Your website.
Yeah.
How you present yourself.
Yeah.
Make it really appealing to a buyer. That whole process you would go through with a high-end house here
Yep.
in LA.
Yep.
You also want to go through on a business,
That's good.
especially a lower middle market.
Yep.
Where it's a little harder.
Yep.
Harder to position it.
That's good.
That's the kind of stuff, and that's why people often get referred into me.
I love it. Andy, thanks for taking time just to
thank
walk
you.
us through some of the education of the process. I think it's invaluable for folks that may have been very successful in their business, but all this function and nomenclature of a sell is all new.
Yeah.
Even if they're very, very smart and talented in their business, this is just a new motion to learn. And I appreciate you just taking the time and speaking to me and us like we're a golden retriever and helping it make sense.
Yeah, and help a company get a good pill of health.
That's
right?
exactly
the whole
right.
idea.
Appreciate you, brother. Thanks for
Thanks
making
so
time.
much.